Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Alex Altmann of Barclays writing, ultimately, it remains all eyes on that confluence of the FOMC, PCE, NFP, megacap earnings window with a sprinkle of tariff threats or relief. Alex joins us now for more. Good morning, Alex.
Good morning.
How are we priced for all of that?
Well, the S&P is pricing in about a 1% move every day over that 3-day window. But what's really interesting is that we've obviously had a long streak of really very little volatility. The market's pricing in a 3-day window of volatility, and then it's pricing in no volatility again. So I would say there's still a relatively high amount of complacency, even over those that 3-day window of 3-letter acronyms.
Tariff threats or tariff relief? The difference between the two? What is the difference between the two? Is this a market, do you feel, that's betting against the administration following through or betting on corporate resilience in the face of tariffs?
I would say the latter. It's quite clear. I mean, the S&P is trading on basically at its cap of what it's been trading from a valuation perspective in a post-COVID era, which is about 22 and a half times. And so if we break out of that, we're starting to question if we're getting into a new regime of valuation and of, dare I say, bubble, which is clearly going to be moving towards tariff relief than tariff fear.
Well, but Chris Harvey had an interesting argument about this. You used the word bubble, but he made the argument that we should be getting to higher valuation levels, given the fact that this is a much more tech-dominant index than it has been traditionally. And we have had this huge industrial revolution underpinning some of the efficiency gains that have allowed companies to absorb some of the tariff costs, et cetera, with relative grace. What do you make of that there needs to be just generally a higher valuation, a higher multiple put on U.S. equities as a result?
I think that's generally been the path over time. If you look at the path of the equity market multiple post-GFC, as profit margins have increased, you've generally seen an improvement in valuations. I would like to pivot slightly and just talk about small caps a little bit, because if we're going to talk about a technological revolution, then we need to start thinking outside the box a bit, beyond just the hyperscalers and the immediate picks and shovels beneficiaries of AI. Let's talk about the fact that consumers get a huge benefit from AI at basically a subsidized cost as a result of these hyperscalers investing, quite frankly, trillions of dollars into this investment at what is currently a low ROI. Think about the consumer benefit. Think about the small business benefit. Businesses that now you're democratizing the process of that AI revolution into, let's call it, small caps. And that's why I actually think the valuation anomaly might actually be in the smaller cap space, which basically has been overlooked for years now.
So this is the argument that people were making last year that didn't really come to pass, that we'd see a broadening out away from the hyperscalers and the big tech names to the rest of the index, because you are seeing that diffusion of some of the tech prowess. Is that sort of what you're expecting now? Is that kind of where you're leaning in? It
is. And also, let's not forget, breadth this year has been pretty good. So we've already seen a broadening out. Best performing sectors in 2025 have actually been things like industrials. It hasn't necessarily been just the mega caps. But then we've also got to start thinking about a regime shift, which has already been discussed in this forum here, which is, what are the Fed going to do? If we're going to move away from a higher for longer narrative to a lower interest rate environment, consider the fact that small caps, 45% of small caps are variable interest rate debt. They're going to get the direct benefit of interest rate cuts. So we can pontificate about whether Mr. Powell is going to resign or the rest of it, and we will. However, the fact of the matter is that we will end up with a replaced Fed chair at this time next year, and we are pretty convinced that the path of interest rates is therefore lower. So we need to think about less about the near term and more about, if interest rates are lower, who's going to be the direct beneficiary. So it's not just the AI angle. You've got lower interest rates, and you've also got the positioning, which has been our guiding light since the beginning of June. From a positioning perspective, look at CFTC data on small caps. It's currently the most short since last summer, right before we had that big squeeze as well.
Even before we get a new Fed chair, we could see the Fed cutting interest rates. When do you have this all timed out?
Well, so Barclays economists have still two cuts for the year. So, September, December. I think that at the end of the day, whether this is one cut, two cuts in 2025, I wouldn't say it's irrelevant, but I would say it's marginal because we're trying to sort of forecast. Remember, equities are supposed to be a forward discounting mechanism. They're supposed to be thinking 6, 12, 2 years out, especially for long-dated securities that don't have many profits today. So in that case, I don't think it matters enormously.
So for small caps, you want to be exposed ahead of September?
Correct, yes. I think the small cap story is really not just about positioning, but it's about that Fed pivot, or dare I say, is the equity market moving into a new regime away from just thinking about the narrowness of leadership and into something a little bit more broad?
Strange things happen in August. Are you hopeful we'll have one of those nice quiet summers?
I mean, I'm going on vacation on Friday.
You're taking some time off?
Yeah, I would very much hope so. But as you say,
nice
August is notoriously volatile. August can be notoriously volatile. If we all recall last year what happened with the BOJ and so on and so forth. I would say that the fact is to your first question, we still have that confluence of events straddling month end. And any of those could potentially derail this low vol environment.
What's volume like at the moment? Just volume?
Volume, volume is okay, but it's massively skewed by the retail cohort. So we're seeing this enormous turnover within a small number of securities as a function of the small investor, which is again a part of a larger discussion.
Can I just follow up on that? What securities? Are they concentrated in the ones we talk about every day, or different kind of companies?
I mean, just for the purpose, I won't name specific names,
sure.
But I'll give you an example that I think it was middle of last week, 4 securities accounted for 11% of total NYSE volume. The collective market cap of those 4 was 2.6 basis points of US capitalization. So these aren't stocks that you talk about on a daily basis.
11% of volume, 2.6 basis points of market cap.
Yes. Of US market cap.
That's amazing.
Yes.
Have you ever seen it like that before?
We have not, no.
What do you think's behind that?
So that is, I would say, retail euphoria. So you've had this prevalence on shift of obviously a multi-year structural phenomenon post-COVID, where small investors have become a larger and larger portion of the tape. They now account for about 25%. Systematic flows, so quantitative flows, account for another 50%. And those numbers have just been growing over time. So the only time we came close to this was in 2021, obviously a very different real rate environment.
But a different backdrop completely. So I'm trying to figure out, just in real time, what's unleashed this recent bout? Because it feels like a very different backdrop to where we were all those years ago.
This goes back to my point of whether are we in a bubble or not. Because we're talking about animal spirits, we're talking about euphoria, we're talking about the fact that there's a lot of small investors still haven't lost their jobs, still getting income growth, still basically seeing the stock market at the highs. And if you remember at the beginning of the year when we spoke on this show, there's a reflexivity in stocks. Because the economy is so financialized, 70% of financial household net worth is tied to the stock market. So on the way down, it feels terrible. On the way up, it feels fantastic.
Is this stupid money or is this smart money? Because they've been the winners. And a lot of people used to dismiss this and say it's a bubble and this means that the market's going to tank. Are people looking at this and saying, this means there are more gains ahead?
Well, I don't want to call them stupid money because the fact of the matter is they've made more money than most professional investors have recently. I would just simply say that these guys are doing what they've been doing or conditioned to do, which is buy the dip. I think what's important to consider, though, is back to this regime shift. Is the market telling us that we're moving to a lower interest rate environment where actually it's a lot of the less profitable stocks that end up being the market leaders? And if you look at things like certain factor behaviors, the only time we've seen this before, these what we engineered as a short squeeze, but it's not a short squeeze, 2009, 2020 and 2021, neither of which were just short squeezes. They were regime changes. And so I think that's what we're pointing towards. That's why we're thinking about small caps more, because it may not just be the stupid small investor. It may actually be something a little bit more paradigmy.
Those numbers are amazing. 11% of volume across 4 names, which account for 2.6 basis points of US market cap.
Yeah.
Unreal. Alex, good to see you.
Nice to see you.
A lot to think about. Thank you. Thank you, sir. Alex Altmann there of Barclays. Brownback of BlackRock calling this quote one of the most compelling fixed income opportunity sets in decades. Russell joins us now for more. Russell, good morning, sir.
Morning.
We've seen a bit of a rally in treasuries over the previous few days. What's behind that big wall of demand?
So, we're calling it one of several transcendent influences today that really sort of drive market outcomes, and that is this wall of money that exists today. So you look in the United States, $218 trillion of private sector net worth. when you put that in comparison to the size of the asset markets today, it really is a world where there's too much money and not enough yielding assets. And so that's a transcendent influence in the face of lots of policy uncertainty, that along with a resilient economy.
Everything seems to have settled down over the past few months. There's something you and the team have said, that genuine economic risk is muted. What do you mean by that?
It's this series of structural, foundational influences that have transcended uncertainties that the economy has faced in 2023 with the regional banking crisis, an acrimonious election last year, and the uncertainty about the sequencing of policies and implementation this year. And yet you get these momentary pullbacks of consumption or investment just as velocity slows, as uncertainty sort of cycles through the system. But then it rebounds. And you've seen the economy accelerate into the fourth quarter each of the last 2 years. It's my expectation you'll see the exact same thing unfold this year.
Which is the reason why you've been reducing your position in cash and deploying, still seeing spread compression through the remainder of the year. I just wonder if the book's really been written on the policies that have been implemented and the policy uncertainty and the ramification on the economy. Why do you think that we have enough information to say we will still see that reacceleration even if some of those tariff ramifications haven't been fully felt yet?
So again, because these underlying influences are so powerful, these policy evolutions are only marginally, incrementally determinant to outcomes. And, listen, I think markets have correctly assessed the tariff situation as benign at the end of the day. At the end of the day, tariffs are a tax. And so the debate about whether they're inflationary, you think about if we were sitting here talking about an income tax, we wouldn't be discussing whether it's inflationary or not. We'd be discussing its impacts on growth. And so when you think about, and many guests have been on your program over recent days talking about how that tariff impact is spread out over so many different nodes of that value chain between the point at which the good arrives at port and when it ends up on the store shelf. So these are marginal sort of shifts in underlying economic actors and the influences there. But overall, these foundational supports are what's driving markets.
And that's driving credit, that's driving equities. How should this really play through in the treasury space, given the fact that we have potential rate cuts coming down the pike, even with strength in the economy, and a real question around how much it's going to be an inflationary push over the next 6 months?
Yep. So I think the bond market has found an equilibrium all throughout this year. It's steepened in deference to slowing growth and inflation that's still above target, and a Fed that will likely deliver a couple of rate cuts by the end of the year. The front end of the curve is anchored to Fed policy. The back end is anchored to nominal growth. And if you think about a 4.5-5% nominal growth outcome this year, that's exactly where the bond market is today. We see this fixed income regime as one where there isn't a big interest rate bet to make. It's about clipping that coupon. It's about the income associated with the fixed income opportunity.
Is that another way of saying this Fed conversation is not that relevant?
So, listen, I actually think the debate that is taking place today is a healthy one where there's credible arguments on both sides. Don't cut or cut. I happen to be in the camp that says the setting of policy today is suboptimal. You think about the K-shaped evolution of the economy today. I don't call it a K-shaped recovery because I don't think the U.S. economy is actually cyclical. But the current policy setting today, think about the savers, which is really the purview of the wealthy and higher income cohorts today, $150 billion a month of interest income accruing to those economic actors. Low income, low wealth cohort households, that's where all the floating rate debt is today, your credit card debt, your auto debt. And so the policy stance today is simultaneously helping the savers and hurting those lower income cohorts. So an adjustment downward, I would argue, might be a bit more optimal.
On aggregate, a net benefit or net negative? It sounds like a net negative.
To keep
rates where they are?
Listen, the economy, again, these transcendent influences, the policy setting today is not going to dent the trajectory of the economy. It's being influenced at the margin by velocity, which slowed earlier in the year and is set to become unleashed in the back half. I think it would be more optimal if the rate came down a little bit and met where the market's pricing cuts today.
Russell, appreciate your time. Thank you, sir. Russell Brownback there of BlackRock on the credible arguments on either side. Sam Zief of JPMorgan writing, despite signs of US economic resilience, we expect further declines in the dollar over the medium term. Sam joined us now for more. Sam, good morning.
Good morning. How are you?
What are the pillars of this dollar weakness view?
Yeah, so there's really two main ones. One, cyclical convergence. The U.S. labor market is still loosening. The Fed, we can argue when it's going to happen, but it's probably over the next couple of meetings going to start resuming interest rate cuts. And most of these other major central banks, the ECB or anywhere else, have kind of finished a lot of their cutting cycle. So we do expect some cyclical convergence there, some convergence between growth and interest rates abroad. And then second is a global asset reallocation story that's continuing. So global investors, we're not seeing any signs of liquidation of U.S. assets. There's hyperbole around. There's none of that. But we're definitely seeing incrementally less inflows into the U.S. And when you set it against a backdrop of a U.S. with a very, very large trade deficit, a very large current account deficit, it needs those inflows just to offset the depreciation pressure on the dollar. So the more that you just see incrementally less inflows into the U.S., we think the bias for the dollar is to leak lower.
Let's address each point individually. 2 points. The first one, rate convergence. The pushback there would be that Europe is facing a disinflationary shock and maybe America is facing an inflationary shock and the rates profile is going to be different because of that. What's your counterpoint to that?
My counterpoint to that is when you look at real interest rates and inflation-adjusted interest rates, then as the Fed starts to cut, even in the face of a slightly higher inflation environment, which is probably warranted given the labor market loosening, your real interest rates decline. And that's the convergence that we're expecting. Maybe not so much in nominal space, but real, and that's what's going to allow the dollar to weaken.
To the second point, the pushback would be that you aren't seeing necessarily outflows from the United States, and you're still seeing quite a bit of allocation to U.S. dollar-denominated assets. People are just hedging more, which is leading to a weakening in the dollar, but not necessarily any sort of reallocation away from the U.S. What's the counterpoint to that?
Well, you're right. I think for the dollar, it doesn't really matter which one it is, right? If you think about a global institutional investment fund, let's say, the first thing they're going to do is raise those FX hedge ratios, which they've allowed to decline in recent years, and that puts selling pressure on the dollar. And then as the assets that they own mature, they decide to undergo an asset reallocation. That's the next leg. And so, yes, I do think immediately what's been happening is an increase in FX hedge ratios. The next way that it continues is that asset allocation story continues. Either way, it results in a slightly weakening pressure on the dollar.
How does the Fed independence story fit in with the potential weakening of the dollar further?
Yeah, I mean, it's not a pillar of our view, but if you set it against a backdrop where already investors are demanding some more compensation to finance the U.S. fiscal deficit, to finance the current account deficit, then this just adds another risk to forcing investors to demand more compensation to that. So it doesn't really factor into our direct baseline forecast, but pushes downside risks to the dollar outlook.
So at the moment, do you think all this criticism is just noise?
I think our view, honestly, has been it doesn't really matter who the Fed chair is. They're one vote among 12. But the perception of the Fed's independence is crucial to thinking about the right value for the dollar or the value of long-term treasury yields.
So in that respect, who they appoint to be the next Fed chair for May, when Powell's term is up, is important.
In the signal it sends over how political the Fed might be, honestly, what that person's view is on monetary policy probably doesn't actually matter all that much. You need to convince the entire committee to either lower or increase interest rates.
How close do you think that committee is right now to reducing interest rates?
Yeah, I think in the next couple meetings, it's going to make sense. I think what's interesting about the debate over Fed independence, again, I won't come in one way or the other, is that if the call was 50-50, then honestly, it's probably incrementally slightly harder to cut interest rates just because it's been couched in such a political environment. But I do think either way, over the next couple meetings, we think that there's 50 basis points of cuts this year and probably 50 basis points next year.
Does it concern you that your call is very consensus and that there is a lot of bearishness right now priced into the market with positioning against the dollar?
Yeah. On a medium term, no, because fine, maybe fast money players, hedge funds, CTAs had gotten very short dollars, although honestly I would argue over the last week or two that some of that's been cleaned out. But the medium-term story, the asset allocation story, the increase in FX hedge ratios, these are funds, these are players that take a long time to make these decisions. I know from speaking from our clients at the private bank, they are having more of this conversation than we've probably ever had before, and still it's a slow-moving process to move from your current asset allocation to another.
Could play out over years. Not just weeks and months.
No.
That point to me was really salient, this idea that we've seen the hedging, but that's the first step. The second step is the allocation shift. And that's what I think a lot of people are very dismissive of by saying, look, the numbers don't show it right now, so it's not going to happen. Doesn't mean to say that that actually won't happen down the line.
Sam, strong defense of your call. Appreciate your time. Thank you. Thank you very much. Sam Zief there of JPMorgan Private Bank. Andrew Hollenhorst of Citi writing the Fed remains on course to resume rate cuts in September. Andrew joins us now for more. Andrew, good morning.
Good morning.
Why September, and what's leaning in that direction already?
Well, I think there's kind of a fundamental argument around September, which is the slowing that we've seen in core inflation. We still have tariff effects upcoming, but services especially look like they've slowed down. Labor market looks strong, but beneath the surface, there are some details that look a little bit concerning. You'd want to be moving towards neutral. That's a fundamental explanation. But then there's also just the Fed rhetoric explanation. They've set this up now. They've said we're going to watch the data over the summer. We're going to make a decision in September. In their dot plot, they've got 2 rate cuts this year, 50 basis points of rate cuts this year. That would also make sense with the September cut. So they've kind of set it up for September. You could argue it's going to be premature in September to know how big an effect from tariffs we're going to get or not in inflation. It's not clear that that's really the month when you're going to have all questions answered, but it looks like that's where they're headed.
On the labour market, in their last statement, the labour market conditions remain solid. Can they repeat that line this month?
I think they can still say that. There is a debate about how solid is solid. Some Fed officials have used the word solid. Other Fed officials have used the word fragile. So you kind of wonder, how can the labor market be solid and fragile at the same time? You look at the headline, we're getting 140,000 jobs per month. That's a strong reading. A 4.1% unemployment rate. That also looks solid. But then you look beneath the surface and you see those 145,000 jobs. Well, really half of them were in the government sector, and there's probably some seasonal adjustment issue there. You look at that unemployment rate. Part of the reason it's low is because the participation rate has gone down, and that's because some workers are actually leaving the workforce because they're not finding jobs. That doesn't look as strong. So I think there is this kind of coexistence of a top-line number, a headline number that looks resilient, and the labor market overall has been resilient, but then these details that do cause you some concern.
We often say the stock market is not the economy. The stock market's not the economy. We see the stock market doing really well on the heels of earnings by companies that are doing really well. How do you counter companies doing very well with an overall backdrop that you see as weakening, as less favorable, just overall?
Yeah, so if we look at the economic data, you look at services spending. I think goods spending has been very volatile, so it's hard to read too much into that. Services spending, we've been slowing, and that's really been the engine of growth for the U.S. economy. You see that in Q1. I think we're going to see that again in Q2. And that's telling us that consumer demand is slowing down. We have a real mystery now if you kind of look at the data, because we know someone is bearing the costs of tariffs. It could be foreign exporters. It could be domestic firms. It could be consumers. We don't see consumer prices going up a lot yet. We don't see foreign exporters reducing their prices a lot, at least in the data. So then that would say that some domestic firms are absorbing some of these costs. That should be negative, maybe not reflected in what we're hearing so far.
So why do you think that we're not going to see any kind of inflationary pressure that would pressure the Fed maybe to remain on hold, despite some of the noise that we're hearing from Washington, D.C.?
So I think we will see some inflation. I don't think that's going to end up constraining the Fed in a big way. And that's because the inflation that we're going to see is going to be in goods inflation. Now, if you looked at the June inflation report, you could kind of see it two ways. On the one hand, we didn't have a big inflationary effect. On the other hand, you had a few categories of goods, home furnishings in particular, where you're seeing some of those early tariff effects, and we'll probably see that in some other categories of goods. But the big question, and this is what Governor Waller has really emphasized, the big question is this going to be just restricted to goods inflation, or is this something that broadens? Are we getting broad-based pressure in services inflation, in wages that are going up, and just a general inflationary trend in the economy? There's no evidence that that's what's happening here.
Do we need to have the final rates to understand that story?
I don't think we can wait until we have the final rates. You would like to, right? And that kind of goes back to, is September the right month to be moving? If the objective was to wait until you had all questions answered, they're not all going to be answered in September. Maybe you'll have some clarity on the August 1st, but maybe not, right? Some of these negotiations may continue. And then even if new tariffs go into effect August 1st, we know where those rates are. How much do they pass through to consumers? What is the timeline on that? What's the extent of that tariff increase? We're not going to have all those questions answered.
Say it is just a 10% baseline overall, and then maybe some different intricate deals for bigger partners. Do you think companies will be forced at all to pass on to consumers, or they're going to hold what they're doing right now, which is to eat a lot of it?
I think you'll see some of that passed on to consumers. Like I was saying, we're seeing some price increases already, but 10% tariff, that's pretty manageable. I think that's something that firms largely could internalize, and you probably don't see that much passing through into consumer prices.
How anchored are inflation expectations, both consumer-based and market-based?
Yeah, I mean, it depends a little bit on which measure you look at, and then you can really get into the issue of, are you just cherry picking the one that you like?
What do you think is more credible?
Well, University of Michigan is the one that's been all over the place, right? That one's much higher. Now it's come lower again. If you look at the New York Fed expectations, those have been more stable. I tend to look at the market expectations. There are issues with the market expectations too. I'm not saying that there aren't. But at the end of the day, people are putting money on the line on those expectations. Those are expectations that in some sense are a stronger read on what people really think, what investors think about inflation. And those have not moved to levels that are concerning.
Right now, I'm looking right now at a market that has just defied all expectations when it comes to looking through all of these ramifications. What are you looking to hear from the Fed next week?
Well, I'm not sure that we're going to get a lot of new information from this Fed meeting. We know that we have a pretty big division across Fed officials. We have some that don't want to cut it all this year. We have others that think you should be cutting in July. That's one interesting element of this meeting. We could get a dissent from up to 2 governors. Governor Waller really sounded like he is planning to dissent at that meeting. We'll see if he goes through with that. That's really notable. We had a dissent from Bowman in 2024. Before that, you have to go back to 2005 before you had a governor dissenting on rate policy. So that would be kind of a signal that there's a pretty big division across Fed officials. I think what we'll hear from Powell is wait and see. We're waiting to look at the data over the summer. We're going to tell you in September.
But he's got to acknowledge the split on the committee, Andrew. I don't think he can get away with going into the news conference to attempt to reflect a consensus that doesn't exist. There's clearly a division. You see that in the SEP. You see that in the speeches from all the Fed officials. How tricky is that going to be in the news conference?
Yeah, I think this is very difficult, right? This is very, very difficult time for the chair when you have even your governors, right, that are maybe at odds over what the Fed should be doing. So I think what he does is he goes back to the data. That's what Fed officials typically do and say, that's why we're waiting and that's why we're watching in July and August. And honestly, probably hoping to some extent from Chair Powell's perspective that they will get a clearer signal. It goes back to what we were discussing with the labor market, with the inflation data. You can read this data a little bit 2 ways, and that's part of why there's a division. Maybe we'll have some more clarity in the data by September.
Andrew, appreciate it. Good to see you. Andrew Hollenhorst there of Citi.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.